All right. Well, Kenny Gatliff, thanks so much for joining me on a Friday afternoon here after market close.
Yeah, happy to be here. Looking forward to another good conversation.
That's right. That's right. We always have a good time. So, for those that this is your first time listening, I'm Dan Pallison, financial psychologist and a wealth manager. Kenny Gatliff here is a CFA, financial or investment advisor and trader. So we like to have some conversations, and I learn a lot from Kenny. We also commit to keeping these conversations less than 10 minutes. So Kenny, I'll jump right in. Um, we've uh, we've had some good conversations recently about different types of asset classes and different types of stocks and different company sizes and how that impacts a portfolio and having U.S. versus international. So all of these different like stock asset classes. But let's talk a little bit about bonds today because I get a lot of questions from clients about bonds. And so if you kind of look historically, I'm going to use broad numbers like we sort of attach like the 10% annual rate of return to stocks and stock investments. Now that's more tied to the S&P 500, but it's just kind of a nice round number. And if you look historically at like a bond investor, they might earn half that, like around 5%. But to be clear, we're not guaranteeing any kind of future rate of return here, but just to use some of these round numbers, but I want you to, I guess my question is, are all bonds created equal?
Yeah, so it is a good conversation. And, you say you have these conversations with the clients, but honestly, I think this is one of the most missed conversations in investing. And, most investors, especially as they get a little bit older in retirement age, are somewhere between 40 and 60% in bonds. Yet it's kind of not talked about. And I think there is this misconception that it's like, oh, it's bonds, it's fixed income, it's kind of all the same. And that's just not the case. The difference between a high quality bond and a low quality bond can have drastic changes in your outcome as an investor. And same thing kind of on the time horizon, with the difference between a long-term bond and a short-term bond. When we see interest rates moving, again, we've seen that a lot recently, right? It does, again, has a drastic impact on the return on that side of your portfolio and the safety of your portfolio, really.
Yeah. Kenny, as you and I have worked together and worked with clients together, you're the one sort of in the back office trading and managing portfolios. And I've noticed when I look at portfolios, when we're recommending bonds, it's mostly short term and intermediate term uh, as
Mhm.
opposed to long term bonds. So why is that? Why are we right now, leaning more towards short term and intermediate term bonds?
Yeah, so I think it's good to know the purpose of the bonds in a portfolio first. And the only reason to have a bond in a portfolio is to reduce the volatility of the equity of the portfolio. You know, it, in all cases, in the long term, we have an expectation that stocks are going to outperform any bond, but we want bonds in there to reduce the volatility, especially for those taking income. And so, with that in mind, we want bonds that are going to do just that, reduce volatility. And as you go out on the yield curve and buy a longer term bond, you're exposing yourself to a lot more interest rate risk. And people should understand that after these last couple of years, when we've seen interest rates spike, well, what does that do to an existing bond? It makes the value go down a lot. And that might be unintuitive for some people, but if you think about the flip of that, if I have a 30-year mortgage and I just refinance for 2.5%, and all of a sudden mortgages out there are 5, 7, 8%, I'm not just trading that with someone on the open market who has an 8% mortgage. Well, it's the same thing in reverse. If I've got a 30-year bond and I'm only getting 1% because I bought it a few years ago, well, I'm not getting what I paid for in the marketplace now that anyone can go out and buy one that's getting 5 or 6%. I see a drastic reduction in value. And the longer you are out on that yield curve, if you have 20, 30-year long-term bonds, well, the more you're going to sustain that loss because you're locking that loss in for longer. Whereas if you have a 1 year or 2 year bond, yeah, it goes down a little bit, but then you can trade it in and buy a higher yielding one as soon as that comes to maturity, and you end up your break evens a lot quicker.
Yeah. No, that's a great point. I like that. I like zooming out and reminding ourselves or asking ourselves what's the purpose of bonds in a portfolio because historically stocks outperform bonds. And so why would you even have bonds in a portfolio if the goal is to grow money? Well, you zoom in and you might need to access some funds over the next few years. And if that's the case, you certainly want less volatility. So the ups and downs being a lot smoother. than just having an all stock portfolio. So I'm with you. I mean, when I talk about bonds with clients, I'll even joke that, hey, these are a drag on a portfolio, but they still serve a purpose. And I think it's important to remember what or how important is it to have reduced volatility in a portfolio, especially in retirement. And especially in retirement, if you're drawing from your portfolio and taking
Mhm.
money out. And so, to your point, the longer duration bonds are more sensitive to things like interest rates. And so we see
Mhm.
the more volatility in those as opposed to the short term. I love the analogy of swapping out your low rate mortgage with someone else or vice versa. Okay, so here's another question that's come up a lot, Kenny. Interest rates, where they are right now, what investors can get, what we can all get at banks in CDs. Why wouldn't we just take an entire bond portfolio? If we're in a 60-40 portfolio, why wouldn't we take that 40% of bonds and just buy CDs?
Yeah, it's a good question. We do get this a lot because CDs have that advertised yield, and people were used to seeing 1% or less than that for a lot of years, prior to 2 years ago, and now they're seeing 5% locked in, and they think, oh, that's a lot more attractive than it used to be. Therefore, it must be a good option. But you might not see it if you own a bond fund, but those yields translate from the CD market to the bond market. So the treasuries or the corporate bonds that you own are getting very similar rates of return. So there's no magic bullet there saying, oh, I can get a better rate of return in a CD or any other fixed product. Everything is
Mm-hmm.
dependent on interest rates, and they all kind of move in the same direction and have similar returns. So I think then is saying, okay, well, why do I want bonds in a portfolio in the first place? Well, kind of as we mentioned, when we're managing a portfolio, that's a comprehensive strategy, right? And the reason it's comprehensive is every year is a little bit different than the year before. And if we are in a position where stocks go gangbusters up 20 or 30%, well, then we probably want to take a little bit of that off the table, move it into the bond portfolio that we're managing right alongside. The flip side is we want those bonds for that dry powder where if stocks are down, well, not only do I not want to sell shares while the stocks are down if I'm taking income, but I want to be able to have that bond portfolio to rebalance into the stocks when I'm getting them at a better price. Some people make the comment that when stocks are down, they're just on sale to buy more. Well, this gives you the option of buying more while they're on sale if you do have that part of your portfolio that is not going down at the same time stocks are going down, which is again the purpose of bonds. They should either hold ground or usually go up a little bit when stocks go down. So you have some money on the side to work with to buy into those stocks when they're cheap.
Yeah. Yeah, and for those out there that are tracking and interested in hearing more, actually, Kenny, our conversation last month, so the last, I guess, recorded episode, was all about opportunistic rebalancing and the
Mm-hmm.
value of not just rebalancing an account once a year or once a quarter, but when there's opportunity, when stocks and bonds are taking your portfolio out of its ratio and having the flexibility to immediately pounce on that and rebalance. And so there's some value with having the bonds to be able to, like you said, buy back into the stocks when they're on sale. And that's just at the end of
Yep.
the day, investing 101 is buy low, sell high, and having some bonds in a portfolio allows us to do that.
And having those right bonds, right? So if stocks go down and the economic environment is such that the bonds that you own unknowingly were exposed to some risk and your bonds are down at the same time as stocks, well, that takes away that benefit. So yeah, that's why it is really important to kind of know your fixed income and know that not all bonds are created equal, to circle back to your initial question.
Yeah. All right, Kenny. Well, we'll wrap up here. I see the clock ticking just after 9 minutes. So again, we did it. We kept it under 10. So I appreciate you. Have a wonderful weekend. I'll see you soon, and we'll record again in a month.
All right, sounds good. Have a good one, Dan.
Thanks, Kenny.